Okay, so the 60th question. Which of the following NBFC categories was created in 2019 by merging asset finance, loan and investment NBFCs? Right. So basically, if you talk about NBFCs, right, NBFCs, some basic information regarding NBFCs. They are not actually banks, they are actually registered under the Companies Act. Okay, Companies Act. Second important point, they cannot accept public deposits, right? They cannot accept demand deposits. Demand deposits. Okay, there are very less exceptions, but mostly they can't actually accept demand deposits. In fact, some sort of flexibility has been provided by RBI, like between 1 year and 60 months. Okay, before any deposit that kind of like an FD, right? Deposits that are maturing between the 1 year and 60 months, they can be accepted, but that's actually a rare exception. Mostly NBFCs cannot accept demand deposits. They cannot issue checks, checks, or cannot issue checks. They are not part of the payment and settlement system. So these are the basics about NBFC, right? So if you see any check or demand draft drawn up by an NBFC like Bajaj Finance Limited, okay, that's not actually true, right? They can't do that. Okay, so in 2019 there was actually 3 types of NBFCs. There are various other types of NBFCs, but majorly 3 types of NBFCs, like for example asset finance. That is, they finance physical assets, right, in infrastructure and those things. Then you had the loan companies, right? So basically they give debt, right? They give debt. Then there were also investment companies. Okay, investment companies, right? So basically these asset finance companies, loan companies, investment companies, they were merged in 2019. Okay, they were merged in 2019, and that was the question, right? That was the question. Okay, so basically they were merged into the investment and credit company. Okay, one category. Okay, one category, investment and credit company. Okay, there are also other categories of NBFCs, like for example microfinance institutions. Some microfinance institutions are there. Then you have the infrastructure finance companies are the infrastructure finance companies. Okay, core investment companies are there. Core investment companies. Okay, core investment companies. Okay, but investment and credit company is a type of NBFC which was formed by the merger of asset finance company, loan companies, as well as investment companies, right? So that was a question happened in 2019. So the answer will be investment and credit company. Infrastructure finance company is another type of NBFC, which we will see in another question. Infrastructure debt fund is actually a fund that is actually owned by the infrastructure finance company. Infrastructure debt fund, right? So this actually used to give loans to infrastructure, right? Then you have the core investment company, which actually invest in securities, right? Okay, so that's also we'll see. Okay, so the next question: infrastructure finance companies must deploy at least 75% of their total assets in infrastructure loans. This is actually correct. So remember, 75%. An infrastructure finance company is an NBFC. 75% of its assets that it owns must be infrastructure loans. Okay, must be infrastructure loans. Loans are assets, right, for a creditor, right? So infrastructure finance companies are required to maintain a minimum capital risk adjusted ratio. Capital to risk weighted adjusted ratio should be 15%, and net owned funds. Okay, net owned funds. This actually means net owned funds. Net owned funds. Okay, of 300 crores. Okay, this is both are correct. Okay, both are correct. Okay, both are correct. This is to ensure that the company does not actually mismanage their funds. Okay, to ensure that infrastructure financing is stable in India, right? The conditions are imposed to ensure financial stability and credibility of IFC. Okay, that's actually true. Okay, so if we can read the options also, you can see that. Okay, so here you have to read the options carefully. You have both statement 1 and 2 are correct, and together they explain statement 3. So always like whenever you study, please read the options also carefully, because UPSC can easily change the pattern, right? So here 1 and 2 is correct, and the reason that they have 75% of the total assets in infrastructure loans, they have a capital to risk adjusted ratio of 15% and net owned funds. All these are to ensure financial stability, right? So 1 and 2 are correct, and they explain statement 3. Okay, so that is also keep in mind, right?